For those who just joined us, I'm Phil Watson, the digital content coordinator. Actually, my business card says something different, but the digital guy from Christian Super. Oh, look, there's a photo of me in my office attire. So thanks for joining us, and I'm going to kick it off by praying. Obviously, we're a Christian bunch, and praying is, we're asking God for help with everything we do. So why don't you join me? So, Father God, thank you for these people joining from around Australia. Lord, we just ask for your help for Gav as he presents this webinar tonight. We just ask for technology to work. We just thank you for the chance to learn, learn how to do property, do it well. Father, we just ask for you bring questions to mind, you help Gav to answer them, and that we'd all, through this, we'd all enjoy you more, we'd be blessed, we'd actually be able to live our lives the way that you designed it. And we just thank you in the name of Jesus. Amen.
Amen. Thanks, Phil. That's great.
No worries.
Just before we do get into the main content here, I'll just, if I can get it to go to the next screen, I'll just walk through the disclaimer, which is basically saying that tonight's advice is advice of a general nature. Please seek personal advice before making any decision. And the key topic tonight is about how to break into the property market or help your kids to. Now, the ideal situation is that you save up at least a 20% deposit plus stamp duty. And the reason for that is to avoid mortgage insurance. So that's an insurance that your lender will charge to cover them should you not be able to pay for your mortgage repayments. And if you can avoid that, it saves a significant lump sum chunk of money at the start of your loan. It's only a once-off insurance; it's not ongoing, but it has no benefit to you. It's all benefit to the lender. So if you can have a 20% deposit, sometimes it has been reduced to lower than 20% depending on the lender, but it is a good place to start. You can utilise grants and stamp duty concessions to help you get over the line with those items. And the first home savers account, which was abolished a couple of years ago, was another good mechanism to achieve that goal. And also in this year's budget, a new scheme, the first home saver super scheme that I'll talk through, is another good way to save to get that 20% deposit plus stamp duty. So once you have that and you purchase your home, the way to work out how much you should spend on a home, this is a good gauge, 30 to 40% of your take-home income. So that's your after-tax income. If you're at the 40% of your take-home income going towards your living expenses, that is rent or mortgage repayments, then you're pushing the limit a little bit. But if it's around a third or 33%, then that's a good gauge of you're in a comfortable zone to be able to afford your mortgage repayments. But don't overcommit. Factor in if you're planning to have a family, for example, and you might drop one income for a time or lower income for a time. But on the other side of the equation, you could factor in if you're going to return to work and you're going to increase your overall family income as well. So you can factor those things in. The other thing, the ideal in terms of buying a property that you're going to live in is to think long term. So have cash reserves, and because you might have time between jobs to help you get by without being under stress. And then also think about insurances. So should something happen to you, either be ill and unable to work, it's good to have particularly death and particularly total permanent disability insurance and income protection cover. But you could also consider death and trauma cover as well to cover that debt should something happen to you. The other thing is once you have bought your own home, then pay off the debt as quickly as possible. So ideally have principal and interest repayments, not just interest repayments, and make regular payments off your mortgage. I see it regularly that people have their pay going into an account that is the mortgage account, and then they redraw on it. And so they end up not actually paying off anything of their mortgage over time because the bank leaves them this really flexible arrangement. So I think it's better to have a more disciplined approach, separate your mortgage payments. And a good way to do that is using an offset account, which means that any money in an offset account reduces your mortgage, but it's not in the mortgage account. It's an account that effectively reduces the mortgage but sits aside. So a cash reserve is often good being held in the offset account. So that's the ideal, that you're buying your own home, you're not overcommitting, but the challenge is with property prices being quite high and having increased significantly over the last few years, particularly in Melbourne and Sydney, it's difficult for people to do that. So if that's your particular scenario, we're going to talk through some options. But before we do that, something to help you save for your 20% deposit is a new initiative commencing from the 1st of July this year, the First Home Saver Super Contribution Scheme. And how it works is that you can put up to $15,000 per year into your superannuation account, and a maximum of $30,000 altogether that can be used as a deposit on your first home. So you can start the contributions next financial year, so the 1st of July 2017, and the contributions plus the deemed earning amount of 4.7% can be accessible, but they won't be accessible until the 1st of July 2018. So you can be putting contributions of up to $15,000 into your super account all next financial year, and then on the 1st of July 2018 you can access that money to use for your deposit on your first home. But it doesn't include your superannuation guarantee contributions. So your money your employer puts in, your 9.5%, is not part of this scheme. It's separate, and it's only the additional contributions that you put in that are going to be made available. There is some tax on the withdrawals, so you'll be taxed at your marginal tax rate, but there'll be a 30% tax offset. So if you're earning between $37,000 and $87,000, your marginal tax rate is 34.5% when you include the Medicare levy. So your tax on withdrawing the money to buy your first home would be effectively 4.5%. There is a great estimator that the government provided on budget night, which is available at budget.gov.au/estimator. And I might just jump to that so that we can I'll show you how that works. So just at budget.gov.au/estimator, you can put your particular income details in. So in this case, I've said $70,000 income, and we're going to salary sacrifice. So this is take $10,000 of your salary and put it into super instead of taking it as income. Actually, next financial year, you are able to take a lump sum $10,000 amount, put it into super and claim a deduction, which is like salary sacrifice. So there's a bit more flexibility next year. But if you do that, what they're saying is that so if you put $10,000 into your super account as a salary sacrifice or personal deductible contribution, at the end of from the 1st of July 2018, you'll have 8,200. I should just increase the size of that a bit, shouldn't I? $8,212 available to you. If you did the same thing the next financial year, after a year, you would have nearly $17,000 available to you, and on the third year after salary sacrificing 30, you would have $30,000 altogether. You would have nearly $26,000 available to you. Now they're estimating that is $6,000 more than if you just saved your income and put it in a term deposit and saved it up over time. So over 3 years or 3 financial years, you can save an additional $6,000 by utilizing this structure. But it's not a really simple structure, and if then there are rules like if you don't use it to buy your first home, or you marry somebody who has already bought their own home, you then can't utilize it. So the money just gets stuck in your super until you can access it when you're 60 or 65, for example. So it's a little bit of a complex system, but it is a good way to boost your deposit by $6,000 over 3 financial years to assist you saving for that deposit. So that's the first Home Savers Super Scheme. Well worthwhile considering. but it may not be for everybody. You need to just make sure that it's the right thing for you. The other thing to consider are the first home buyer grants and stamp duty concessions. Now they're different. It's a national scheme but administered by the states under their own legislation. So this is a great site to go to, firsthome.gov.au, and it's got all the links to the respective states or territories. So if you're in Queensland, select Queensland, and it'll explain the grants and the rules around the grants and any stamp duty concessions that are available to you as well. So it's a good place to start. In Victoria, for example, they've just they've proposed to increase the grants for homes in regional areas or new homes in regional areas to $20,000. So you get a $20,000 first home buyer's grant if you're building a new home in a regional area. So check out your particular state or territory and see what's available to you. So they're the two schemes to help you buy a home. If you can't afford to buy your own home to live in, this is, I guess, the crux of the webinar this evening. Let's just talk through the options. So one is you can rent long term and build up your other assets. So other assets being, it might be super, it might be that you're focused on building a business, you might have a share portfolio, or you might have other property, like we'll talk about in other scenarios. It is a valid option. I think ideally it is good to own your own home because it is a capital gains tax-free asset, as in you don't pay tax on it. So it is good to own your own home if that is possible, and but it's not the only path. There are other options, and renting long term can be one of those options. It does provide extra flexibility as well. I've done a number of comparisons for people in retirement, and even close to retirement, even though when you're on the age pension and are renting, you can get some rental assistance. It does, because your cost of housing is really fixed if you own your own home, rather than rent indexing up all the time. It does have a better impact, even though you don't get rental assistance when you are on the age pension, to own your own home if at all possible. So I think it is still good to focus on purchasing your own home at some point. The other option is to buy in a cheaper location or a lower cost property. So, and that's a valid option, and it's an option that most people consider at different times. But you just need to factor in travel costs, schools, amenities, and how that's going to set up your life situation. But it's definitely a valid way to go, and a great way to help facilitate entry into the property market. And the other thing is that it doesn't need to be where you end up long term. It can be an interim measure, pay down the mortgage, and then if you have the capacity then to move to the location that you prefer, then it's a good stepping stone. But you would ideally have at least a 5-year period, a 5-year investment time frame when you're investing in the likes of property, because there are generally high entry costs and selling costs. So real estate fees and stamp duty. The other option that is becoming increasingly popular, particularly in Australia with negative gearing, is rent vesting. It's where you, rather than owning your own home and living in that property, you rent or live elsewhere and own a property that you rent out. The benefits are that currently, under the existing rules, mortgage repayments are tax deductible, whereas normal house mortgage repayments in a house that you live in are not tax deductible. So there's a benefit there. As long as negative gearing stays in place, and whilst it's Labor's policy to eliminate negative gearing on new properties, it still is available at the moment. It creates a little bit more flexibility because you can move around, whether your job moves around, you can move around and rent other properties, and you can just continue to rent out your investment property. So it creates flexibility. It is ideal if you can live in the property first, even if it is for a short time, and satisfy the primary place of residence requirements. So you buy the property, you live in it, and then it's considered your primary place of residence, and then you can move out and lease it out, and you can lease it out for up to 6 years, and it will still remain a capital gains tax-free asset. You can then reset that 6-year period by moving into it again, or it being vacant for 12 months, and you can reset that 6-year period again. Otherwise, it's a pro rata sort of application of capital gains if you sell it having rented it out for longer than that 6-year period. But it is a valid option, and it is becoming increasingly popular with Australian young investors. Vicky's just asking, is the first home owner saver scheme still only available if you live in it, even if only for the first 12 months? Yeah, so you just need to move into the property. So if you took advantage of the first home savers superannuation scheme, you could still utilize it to rent vest. So as long as you haven't owned a property previously, or your spouse hasn't owned a property previously, you could use the first home savers superannuation scheme, buy the property, and then live in it, satisfy that primary place of residence requirements, and then you could lease it out and go down that rent vesting approach. Good question, Quentin, around how long you need to live in it to satisfy the primary place of residence. Traditionally, I used to say 12 months, but you don't necessarily need to be 12 months. You just need to show that it was your primary place of residence, you were living in it, you had the utilities in your name, phone connected, etc. So there isn't a specific time frame, but if you wanted to be 100% sure, 12 months would be more than sufficient. But it can be a shorter period of time. Now, the other option, which I don't see being utilised as commonly for those that can't purchase their first home to live in, but it is another option. It's where you purchase property within superannuation, and you would need your own self-managed super fund to do it. But what you can do is use your existing superannuation balance to help you as partly as a deposit to buy your own home. The home is purchased within your super fund, so you've got all the superannuation rules that you need to work within, which include the fact that you can't lease the property. You can't live in the property yourself, and you can't lease it to family or friends because there is this sole purpose test with superannuation. It's supposed to be the sole purpose test means that you can only use it to help provide for your retirement. So you aren't allowed it's got to be an investment only. You can buy a property, you can borrow funds within your super fund to buy a property, and you can use your super contributions to pay off the loan. And then when you have access to your super money, you can actually then transfer it out of your superannuation fund into your own name, and then you can live in it at that point in time. But you've got to satisfy that condition of release to access it, and you've got to pay stamp duty on the transfer of the property outside of the super fund. And the other drawback of it is that there are setup costs of the structures. So you need to set up a self-managed super fund, and you've got to have a bare trust to do the lending as well. So there's setup costs and ongoing costs that often mean that it's not the ideal situation for those that are trying to get into the property market, entry into the property market. But it definitely is another option. Just got a couple of questions coming through. Henry is saying, is there a minimum amount of super fund for SMS to buy a property? Yeah, there is generally. You need at least a 30% deposit. So if you think about a 30% plus stamp duty, you need that sort of deposit. So let's say it's a $1 million property for round figures purposes. You would need 300,000 plus stamp duty, which would be maybe another 60 grand, depending on which state you're in. So you might need $360,000 to purchase a $1 million property. The other thing to factor in is the lending cost is high within your super fund. So commercial lending is around 5.7, 5.8% for those types of loans at the moment. And whereas you might be able to get a loan in your own name for, say, that you're on a house that you live in for, say, 4%. So yeah, you've got to weigh up the pros and cons of all these options. Will stamp duty be payable from the super fund? Yes, Henry, it will. Stamp duty is paid by the super fund. Yes, that's right. So there are a range of options that you can pursue if you can't buy your own home to live in, and it's about weighing up all the those options. One of the key questions, and probably with the a significant number of you in the 50 to 65 year age bracket, you might be interested in how you can help your children get into the property market, and it is a conversation that happens probably with 50% of my client base would have this as an objective, that they would like to help their kids get into the property market. So it's a common conversation that I'm having, and part of the trigger for having this webinar. That's the first time we've done this topic. The first thing that parents can do is help with cheap accommodation. So help them by letting them live at home. I've seen it regularly where parents, it might be newlyweds living at home, where the kids save up to deposit, or they might be building a property or what have you. But providing that cheap accommodation is a really big free kick for young people to help build up their deposit. Another option is to go guarantor for your kids. So they might not have the ability to get the lending they require to purchase a property that they need, and so you can actually go guarantor for your kids, which means that if your kids can't pay or keep up with the mortgage repayments, you have to. There's a couple of different ways of doing it. One, you can provide your home as security, or you could provide a limited portion of your home as security. So it might be they wanting to get enough of security on your home to avoid mortgage insurance. So there's two different ways you can go guarantor. But I'm not a big fan of this approach because from a biblical perspective, there are some pretty clear guidelines that if you warning against going guarantor, and that if you have gone guarantor, then get out of the situation as soon as possible. So for that reason, I'm not a big fan of it. Even though it is used regularly, and lenders often utilize this approach to help people get into get the security for kids to get into the property market. Another option is to loan money to your kids. So you might have surplus funds that you're able to loan to your kids, or you might be prepared to loan the funds at, say, 3%, which is below the market rate of 4% and above the fixed interest rate that you might be able to get for your investment. So it's a win-win on both sides. My caution here is that whilst I've seen it work well on many occasions, I've also seen it cause significant problems on many occasions as well. And I guess it gets back to that biblical principle that the borrower is servant to the lender. And it changes relationships when you're loaning money between family members. There's a commentator that says Christmas dinner tastes different when you owe money to your folks, so it can cause complexities. And if, for example, you've loaned the money, so that you're kind of creating that link. And then if you're seeing your kids spend money in a way that you don't think is wise, it can start to create that friction. And I've had multiple conversations along these lines with both sides of the equation. So I'm not a big fan of it, but it does sometimes work. It does work regularly, but I'm just not a big fan of it based on my anecdotal experience and those biblical principles as well. The other thing is you can invest with your kids, and I think it might have been Kerry or Karen asked me about this. Is it a good idea? Is it another option to invest with your kids? So you might have a young couple who are going to buy 2/3 of the property, and you might buy the other third. It is an option. I've seen it happen before. It's not the desirable option, but it can be done. The complexity is around the differing objectives. So the young couple who's wanting to treat it as their home, or have got sort of a home interest that they're wanting to create a home. The parent who's investing is investing to help out the kids, but also if they're wanting some return on investment, they'll need to get a partial rent payment on it as well. And then the thing that you would really need to document well is try to go through every single possible scenario that you can think of and decide what you would do in that scenario. So what if mum wants to, or dad, depending on mum and dad wanting to get out, for example, of the property, and the kids couldn't afford to, how would you manage that? Would the whole property have to be sold? If the kids want to buy out the parents, then stamp duty is payable. It's just another complexity that if you can avoid, it would be good, but it is another option as well. You just got to manage the competing interests. Another option is invest for your kids, and I've seen this a number of times where parents might not necessarily have invested for kids initially, but then they've ended up with a home or multiple homes that they want to pass on to kids. I've encouraged them, if they don't need the asset, to do that sooner rather than later for a couple of reasons. It means that if there's capital gains tax associated with it, then you can minimize the tax because the valuation is lower. You can pay a lower amount of stamp duty because the valuation is lower. And it also has an impact on Centrelink if you might be or could be eligible for Centrelink, because if you gift an asset, Centrelink will consider that asset still yours for 5 years after you've gifted it over the gifting thresholds. So it is another option, and I've seen it happen a number of times, but you do have to factor in capital gains tax and stamp duty into the equation. Henry, you were just asking about self-managed super fund out-of-pocket money. So in a self-managed super fund, if you own a property that is negatively geared and needs more money being contributed to it, you can potentially use your superannuation contributions, your employer superannuation contributions to make up the difference. Sorry, I've just got another question come through. Just a moment. Invest for kids, give a scenario. So this is where I've got a couple of people that have done this. So what they invest for kids really is, your kids can't buy a home, but you can afford to, and these other options aren't what you're wanting to pursue at the moment. So investing for your kids might just be you invest in a property in your own name, you own it, and you might just lease it out, and you're growing that asset. So at some point in time in the future, either when you die or prior to that, you can pass it on to your kids. So it's really just investing in a property for your kids because you can afford it, but they can't. But if you can afford to do that, then the other consideration would be could you potentially gift the funds? And this is probably, you've got to weigh up all these options, but the key ones that I like is providing that cheap accommodation to build up the deposit, and then gifting funds to kids, because there's no strings attached in the gifting scenario. But if you have eligible for or will be eligible for Centrelink in the next 5 years, then you really need to factor in the Centrelink implications of gifting funds. So the benefit of gifting funds versus loaning funds or going guarantor or investing with your kids is that the concept is that there's no strings attached. You're gifting the funds. One criteria is that you need to pass on financial wisdom prior to gifting the funds, because if they're not conducting their finances well, more money is just going to accentuate that. So passing on or making sure they've got the wisdom to deal with it is a good place to start. But gifting the funds means there's no strings attached, and even when you feel those that friction of I've gifted these funds and the kids are not spending it how I think they should. You can just remind yourself that you did gift it, no strings attached, and just go back to that position, and it just frees you up. It frees them up, and there's no bind there. So I tend to, based on previous experience and anecdotal experience with clients and etc., to like these couple of options, providing the accommodation and gifting funds to the kids. You'll obviously need to make sure that you've provided sufficiently for yourself before you go gifting a lot of money to the kids. Henry says, my tax consultant said the cost of managing this SMSF is quite high. Is that true? What is the ballpark figure? Yeah, that was one of my drawbacks of a self-managed super fund. So I kept coming back, Henry, to your self-managed super fund question. They are quite high. So to establish a super fund, it might be a $2,500, for example. It might be another $2,500 to set up the Bear Trust, and you might be looking at another $2,500, depending on the complexity of and how well you account for the transactions throughout the year. It might be another $2,500 each year to manage the self-managed super fund or do the accounting on the self-managed super fund. So there's some ballpark figures. So maybe $5,000 set up, and then $2,500 ongoing or thereabouts. It can vary. It can be less or more depending on the providers. What are the limits for gifting and over what period? Yeah, good question, Morris. I'll come back to that. I think that might be actually the next slides, so I'll walk through that now. So this is really thinking about parents gifting funds to kids. How much can you gift, and how does it impact Centrelink? So for Centrelink purposes, deprivation of asset or income is when you destroy, dispose of, or diminish the value of an asset or income. It's not as often related to income, but it can be. And you don't receive any adequate consideration. So the classic example is where we're giving away, let's say, $100,000 to our kids. That might mean that if Centrelink didn't have their deprivation rules in place, that it would reduce your assets by $100,000. And under the current rules, if you're asset tested, you could increase your Centrelink age pension by $7,800 per annum by reducing your assets by $100,000. And so they've put rules in place to limit how much you can do that. And so I'll try and explain that. Other examples of deprivation rules is where, you know how I talked about going guarantor for your kids. So you've provided the bank security, perhaps your house. Let's say that their loan, they weren't able to make their loan repayments, and the guarantor clause was activated, and you had to, say, for example, pay out $40,000 to pay out the difference in the loan versus the value of the property. So if you take that $40,000 and pay out their loan because you're responsible for it, that $40,000 will be caught in deprivation rules. Another example is if you access equity in your home, so you borrow money against your home and give it to the kids, then that would be an example of gifting that would be caught up in these rules. You could sell an asset. You might transfer the ownership of a property or a car, for example, to your kids for no remuneration. That would be considered gifting. And the other one that comes up regularly is if you're receiving an inheritance and you choose not to accept it. It's written in the will that the inheritance is to come to you, but you choose not to accept it and pass it on to the kids, then that is also considered deprivation as well. So you've chosen not to receive the asset. It's treated as if you've received the inheritance and passed it on, and therefore caught up in the gifting rules. It is often good if you want to pass assets on from the generation above you to the generation below you, to change the will so that it can be skip your generation, so there's no Centrelink impact. But that's the rules of gifting. And so what are the limits? You can gift $10,000 per year. This is per individual or couple combined. It's the same for singles or couples. You can give $10,000 per year or $30,000 over a rolling 5-year period. So if you exceed those amounts, then the asset is tested for Centrelink purposes for 5 years after that date. This third graphic is just explaining that if you are eligible for the age pension in 2 years' time and you give away an asset, so 2 years prior to being eligible for the age pension, if you go over these limits in terms of your gifting, the amount over these limits would be considered an asset for Centrelink purposes for 5 years. So 3 years into your age pension, you would still have that asset tested as an asset for 3 years. So you need to be careful if you're going to be eligible for the age pension within the next 5 years when you are looking at gifting assets. Here's just a quick example, and it's just to show the difference in how the annual limit applies and the 5-year limit applies. So we're saying last financial year that we gifted $20,000, this financial year $20,000, next financial year $10,000, and in 2018, 19, $15,000. So let's have a quick look at how it applies. So the annual limit is $10,000 and we've gifted 20. So $10,000 will be considered a deprived asset, and that will be considered an asset for Centrelink purposes for 5 years until 2021. So what's happened here is that we've gifted 20 grand. Our assets for Centrelink purposes will reduce by 10 grand because we can give 10 grand a year. So that would, if we were tested under the asset test, increase our pension by $780 a year. It's a pretty good return. Not many investments you could return 7.8% consistently. So it's actually a good return on investment when you gift funds and increase your pension in doing so. The other $10,000 is going to be an asset for the next 5 years. But we didn't trigger the 5-year rule. So it's only $10,000 that is going to be tested for 5 years. In the next financial year, we do the same thing. We again get $10,000 as under the concessional limit, and then $10,000 will be considered an asset for the next 5 years. So in 2021-22, it'll drop off the Centrelink testing. We still haven't triggered the 5-year rule. Even though we've gifted $40,000, we haven't triggered the 5-year rule because it's only $10,000 each year or $20,000 that has been concessionally tested. Now in 17-18, we're saying that we're gifting $10,000. It's under the annual limit, so there's no impact there, and it's under the 5-year limit because we've had $10,000 here, $10,000 here, and $10,000 here that has been concessionally tested. It hasn't impacted our assets. But now we've hit our limit. So in the final year, we give $15,000, and that breaches both the annual limit. So we're $5,000 over our annual limit. So there's $5,000 here. And because over the previous 3 years, we've already utilized $30,000 of the concessional amount, we're now $10,000 on the 5-year rolling deprivation. So this $15,000 that we've gifted will be an asset for the next 5 years. Won't come off our Centrelink testing until 2023-24. So it's a little bit complex, but if you go on the principle that if you gift more than $10,000 a year or $30,000 over 5 years, it's going to be considered an asset. I've got a couple of questions coming through. April asks, is there an option to buy an investment property and your kids rent it with a view to them buying it later? Yeah, certainly. So that's that you buy the investment property, it's in your name, the kids can rent it. depending on, assuming that Centrelink's not involved, the implication would be that at some point in time, you'd have to transfer the title to them, so they can buy it over time, or you can be provide vendor finance. You can finance them to buy it, so you transfer the title into their name, and you have a loan with them. Or you can set up a transfer ownership over time each year as they're able to put in more money to purchase the asset or increase their ownership proportions. So yeah, you definitely can do that. It's just a matter of how you facilitate it, whether you do it in a lump sum or chunks over time. To some degree, doing it over time may manage the stamp duty obligations a little bit better. Because you can potentially reduce your stamp duty payment. But yeah, it is definitely an option there, April. Thanks for the question. So that's one example of how gifting works. If I go to another example, and this is where you might want to try and stay under the limit. So if we just gifted $10,000 each year over 3 years, then we're not going to trigger any of the deprivation rules. And we've gifted the $30,000, and if you're asset tested for the Centrelink age pension, over that time frame you will have increased your age pension by $780 each year. So for every $10,000 of assets, your age pension reduces by $780 per annum. So 3 times $780 is what the increase in your age pension would be. So there are some positive outcomes of gifting, because if you put this money in the bank, you're likely to get 2.5–3%, whereas with Centrelink age pension payments, it's effectively a 7.8% return. But you might say, well, that $10,000 isn't going to actually help the kids. It's not enough to actually get them a deposit to help them buy a home. So another option is to gift them $10,000 and loan them $20,000. So what that means is that you've not breached any of your limits, and then the next financial year you can say, well, I'm going to waive the $10,000 of that loan. So this financial year you've forgiven 10 of the $20,000 loan, which means that it comes under the concessional gifting rules. And then on the third financial year, you gift, you forgive another $10,000 of the loan. So there's no loan now, and you've gifted the $30,000 without triggering the deprivation rules. So just another way to structure things without triggering deprivation. You consider it a loan for the short time. You just got to update Centrelink that you've got a loan here, and then you've forgiven that loan. Vicky's just asking, how would stamp duty work? It is done over time, or if it is done over time. You'd have to check your state-based legislation, state or territory-based legislation, but the higher the value property, the higher the stamp duty. So if you're selling a property or transferring a property of $1 million, you might pay, let's say, $60,000 in stamp duty. But if you sell an asset worth $500,000, you might pay only $25,000 of stamp duty. So if you transferred it over 2 years, for example, or at 2 different times, you might pay $25,000 on the first $500 and $25,000 on the second $500, which is lower than $60,000 if you transferred the asset at $60,000. So you do need to be careful, because if you've put a contract in place and it's just a contrived scheme to avoid stamp duty, you'd probably get caught in the stamp duty. But if it's a valid arrangement where you're just transferring a portion of the property, and then at some point in the future you transfer another portion of the property, then there is some, there's validity in it, and you might be able to reduce the stamp duty cost. George asks, under vendor finance for first home buyers, is stamp duty in Victoria still applicable when the title transfer to the buyer, when the buyer gets a bank loan and pay off the vendor? Thanks. So vendor finance is basically, there's all sorts of different arrangements and there is many as you can creatively think of, but the simple approach that I was suggesting was that you've actually, mum and dad own the property, they sell the property to the kids, they pay the stamp duty on transfer, and they set up a mortgage arrangement with the parents. So it's basically they're loaning the money from the parents and will pay them off over time. But there's many varied variations of that that you could put in place as well. Thanks, George, for the question. That covers off a lot of the content that I had wanted to walk through, but certainly online to ask any more questions that you have. Otherwise, I might just skip through to some of the questions that you asked on registration for the webinar. But if you do need more information or help, then there's our website or the email address there, or you can give us a call on the 1300 275 428. And then Christian Super is also available at their website at members at christiansuper.com.au and 1300 360 907. One question was, I think it was Michelle, is it really worth investing at 50 or do I buy a caravan? Then good question. If you can, it's good to look at investing, but there are effective, retirement type of accommodation that is provided at low cost that you can actually move into in retirement as well. So there are other options out there. There's granny flat options. There's a range of different things you can do to achieve what you're wanting to achieve. Lower cost areas, lots of different creative ways to achieve what you're wanting to. I'll just go back to a few of you asked questions online. Vicky says, how could these scenarios be utilised if the reverse were the case, where the parent requires help and the children are able to do so? Very good question. I guess the similar principles would apply in that thinking through the scenarios that I talked about before, there's the same range of options. You can go guarantor, you can lend money, you can gift money, you can provide cheap accommodation, you can invest with them, but the same principles apply. Ideally, they're able to stand on their own two feet, and if you want to, you can gift the funds to them, no strings attached. I like that approach best, but you've also got to make sure that you're not if it's all legitimate and they need it, and but there are cases where parents aren't going to utilize the funds well as well, so you've got to vet that sort of scenario too. But yeah, same principles apply, it's just in reverse. One of the consistent themes that came through is, like, how do I afford a house? How do I save up a deposit? It really gets down to the basics of incomings, outgoings. How do you increase your income? How do you reduce your expenses so that you create buffer and save that deposit? There's no lightning bolt solution to that. It's really the basics of how much are you spending, how much can you save, can you increase your income, can you decrease your expenditure to help save. Someone did ask, I can't remember who it was, but they're asking for the difference between, say, shares over the past 20 years and the performance of property over the past 20 years. And it's a really, I guess I can see where you're coming from, and you probably can get the charts, but there's property and there's property. Even within the Melbourne, Sydney, Brisbane, you can have very different investment experiences within those cities, let alone regional versus Western Australia that's suffered more from the mining boom than the East Coast, or Darwin that suffered more from industry moving out, etc. It's so hard to say with residential real estate, compare that, because it's such a differing experience across the country. And that, we talked about gifting, but one thing we didn't cover off was there's different ways to gift. You can actually just give them 10,000 or 20,000 or 100,000, whatever the figure is, or you can motivate them to create positive behaviours. So you might say, "I'll match your additional contributions on your mortgage, or additional payments on your mortgage." So a range of options there. Wendy says, if I am a single 56-year-old woman and I own my own home, is it worth buying another property? Yeah, good question. I come up with this one regularly, Wendy. Your main options with investment at that point in time, if you have surplus cash and capability, is weighing up the options of, do I go and invest in a property in my own name, potentially negatively geared? And in that scenario, you're looking at, in a negatively geared property scenario, what you're doing is you're making losses on that investment over the years, with the idea that you're banking on the capital gain being greater than those accrued losses. So that's one option, the investment property. If you can buy an investment property that's break even, that's another option. But if you do that, then you might pay tax at your marginal tax rate, or generally around a third or 40% of the profit on the property. The second option is you could do a similar thing, either with lending or not lending, into the share market. That's sort of option two. Generally recommend not lending to invest in shares, particularly at that stage. The other option is to really focus on superannuation, because at 56 you either hit your preservation age or you're very close to it, and so you can access some of your super money, and you could potentially make contributions to your superannuation and save tax in the process. So salary sacrificing money to your super, let's say $10,000 to your super, generally saves you between $2,000 and $2,500 per annum. So if you can take advantage of that, that's a really good place to start. If you've got surplus funds over and above your, maxing out your salary sacrifice or concessional contribution limit, then you could think about an investment property. But at that stage, you really got to weigh up: do I go into an investment property, taking on debt, or do I just build up my retirement assets in superannuation? And it kind of relates to your cash flow, your appetite for risk, and I guess utilising those super contributions. So it's weighing up those range of options and working out what the best is for you. But it is a valid option to go down the property track. Often at that stage, it is good, particularly if it's going to be a positively geared investment. It is well worthwhile considering doing it within super, because then you can avoid or not pay capital gains tax if you can move the funds to pension phase. Hopefully I've covered off some of the options there for you. Thanks, Vicky. Appreciate you being on board and your interaction. Have a good night. Quentin, if I have an offset account for an investment property, I understand that the interest on the mortgage is deductible. However, if I have an offset account for a residential property and then draw money to invest in shares, would the interest on the amount withdrawn for investing in shares be deductible? I like your question, Quentin. The tax deductibility of lending is based on what you use the money for, not what it is secured against. Looks like we're nearly out of time and out of questions. So thanks very much for joining us. You know where to find me if you have further questions. But thanks again, and good night.